Hi everyone, I'm James Harte from littlefishfx.com. Thank you for joining me for this week's live market analysis. And as it's the first of the month, we're actually going to kick off with a monthly session taking a look at the technical landscape for the month ahead. So as ever in these sessions, we're going to run through the major currency pairs, looking also at the dollar index, talking a bit about the key fundamental developments, and then assessing the technical landscape for any setups. So if you have any questions during the session, please just write them in the chat function and I'll stop periodically to answer them. Now, as ever, we'll kick off first of all with the US dollar index. So the dollar index then still supported at these current levels. We've been noting over recent weeks that USD price action has been largely bullish, and so really it's just a continuation of that same story at the moment. We've had quite a few key developments over recent weeks which are currently supporting the US dollar. We've had a series of Fed members speaking in support of the Fed's proposed rate path of 2 hikes this year, with some members actually noting the possibility of 3 hikes. We then had the release of the April FOMC minutes last week, which pointed to June specifically, with members feeling that it would be appropriate to raise in June if Q2 data continues to pick up. And then finally, we had these sentiments reiterated on Friday in comments by Fed Chair Yellen, who confirmed that a raise in the coming months was likely appropriate should data continue to pick up. So on the back of this vocal support, we've seen the USD striding higher with bulls continuing to take price up. We then had April PCE data yesterday, which is used as a key inflation gauge by the Fed. And this came in line with expectations. Personal spending actually over the period was better than expected. However, the upside yesterday was tempered a little on news of weaker than expected consumer confidence and weaker manufacturing gauges. But for now, USD bulls still have the ball, so to speak. So looking first of all at the monthly chart, we can note a really important development by the instance of this big bullish engulfing candlestick. So this is a really strong reversal signal. And if you note the location, we've moved into this really key structural support. So this is key medium-term support here. It's the lows from last year. So the presence of such a strong reversal candlestick at this key level indicates that we're likely to see a rotation back up into the upper end of this range. Now, if we drop down onto the weekly charts, you can see that we're currently challenging quite a key level on the dollar index. So we've moved up into a test of this big broken support level here at the 95.80s mark. And you can see that we have the 50% retracement from last year's highs coming in just above that level. So this is a really key short-term price pivot for the US dollar index. And it's a level that we've been noting quite a lot over recent sessions as being really key in determining the likely direction over the short term. So thinking about that big monthly bullish engulfing candle then, like I said, we can anticipate that we're going to get resolution higher within this range. However, after such a strong monthly close such as that, it is typical that we would get some sort of retracement, okay? We do get some profit taking on the back of such a big move like that. And so we could expect that the dollar index is going to pull back a bit, okay? We're also at this really key technical level. So there is definitely scope for some retracement here. Now, if price does start to pull back from these current levels, there are 2 clear areas which I'll be watching for as support. And if we drop down onto the daily chart, just to make those levels a little clearer. So the first one is going to be this area here. So a retest of the back of that broken 38.2% retracement around the 95 mark. You can see we have this previous low here, this ledge of previous highs. And then we've also already tested that as we've broken out above it. So this looks to be an area where we could find some interim support, okay? You can see that we've actually just broken above that short-term bearish resistance trend line. We're currently stalled at this level. So if we do get a move back below here and we break below this support level at 95, the next level that I'm going to be keeping an eye on is actually going to be deeper, and it's the retest of the broken 23.6 level at around this 94 mark. You can see we have this level of previous lows here and a previous high. So this is good structural support. So if I go ahead and mark that up so you can see that clearly. So these are the two support levels that I'll be looking at then if price does pull back from current levels, the 95 mark, and then below there, the 94 mark. However, as I say, the USD view for me at the moment is still bullish over the month, okay? That big monthly engulfing candle signals that we're likely to move higher. However, there is some scope for short-term retracement on that move before we get the next leg up. The key for USD direction here, obviously, we have the big employment reports on Friday. We have the non-farm payrolls and the unemployment rate on deck. So two major news announcements which have the potential to provide the catalyst for either an acceleration higher from current levels or a retracement lower. Now, if we do get the move above this current high, so above the 95.90 mark, above this 96.20, 50% retracement from last year's highs, then that's going to signal a clear breakout move to me, and I'll be looking for a move up into the next resistance level, which is of course this next key Fibonacci level. So the 61.8% retracement from the highs, you can see comes in at this big previous broken low. So we've got the confluence there between a key Fibonacci level and a key structural level. So this is definitely a level that I'll be keeping an eye on if we break out above here, and I'll be targeting that with any long positions that I initiate. So for now, again, the key remains to keep an eye on the employment reports this Friday, not expecting that we get much movement ahead of them. Okay, we've got ISM, either manufacturing or non-manufacturing, coming out later today, but really the key data is at the end of the week. So expecting that to provide the catalyst for the next move in the dollar index. So just to summarize then, that monthly engulfing candle is really what's giving me my directional cue here. And I'm anticipating that whether we break out initially or whether we see a retracement first of all, that eventually we are going to get continued upside here. And obviously with expectations building ahead of the June FOMC, if the employment reports on Friday are strong, then this could be quite a sharp move. Similarly, a weak move is going to see rather a lot of disappointment and unwinding of expectations. So this is really going to be a key print on Friday. So let's take a look then at the major currency pairs and see how this analysis translates. Okay, so looking first of all at the euro then. And really the euro has moved out of the limelight a lot over the last month or so. So following that huge stimulus announcement that we had in March and the initial fireworks which followed that, we've entered a lull. So we saw the ECB keeping policy unchanged at its last meeting with a fairly muted statement. And then since then, not a whole lot has happened. We've had Eurozone inflation, which has stayed negative, so clearly still a problem. But confidence in the Eurozone is improving. We've seen the last two Eurozone economic confidence surveys stronger than expected. And also the continued rally in oil is likely to be warmly received for its positive impact on the inflation outlook. So the key to this week is going to be the ECB rate decision tomorrow. But really expecting more of the same tomorrow, expecting policy to be maintained at current levels and a broadly similar outlook to last time around. Certainly going to be interesting to see how the positive developments in oil prices appear to the ECB and just how much weight they put on them, given that recent negative inflation reading. So looking at the chart then from a technical perspective, and if we start on the monthly chart, you can see really that we've just got the inverse of the US dollar index. So we've got this big bearish engulfing candle on the monthly, which signals that we're likely to get a move lower. So if we drop back down to the daily charts then. So last time around, you can see that we were looking at price as heading down below this key structural support levels. This was our breakout zone. So we were short targeting a move down into these tests of rising trendline support. So we were targeting a move down to this level, expecting that from here, we were going to see a bounce. So obviously the move back down to this level would hit key technical support. We'd also have this really nice symmetry support with a retracement there equal to the length of this initial retracement. So really nice technical support, really nice symmetrical support. However, you can see that we're currently stalled just above that level. We're stalled at the 61.8% retracement of that move from the March lows. So we could get the bounce from current levels, I'm still anticipating that we're likely to get a move down just to test that rising trendline support. But then the move ultimately that I'm looking for, and you can see that we've still got it drawn on the chart from last session, is that we're looking for price to make a bounce. And the initial level we'll be looking at is a retest of that breakout support. So a retest of that broken support at the 112.20 area, which you can see is a retest also of the broken 50% fib level. However, the move ideally, which I'd like to see, is a move back up deeper into this broken 38.2% retracement at around the 113.12 mark. So you can see this is also a key structural level. We have these previous highs here. So a move back up into this level would be a nice retracement on that monthly bearish engulfing candle. And in terms of the actual move itself, that would take us up to roughly the 38.2% retracement of that big monthly candle. So if we get a move up there, I'll be looking for a signal then that price is going to roll over. And then ultimately, the key trade will be a break of this rising trendline support. And ultimately, we'll be looking for a move down into this level here. So the March lows at around the 108.20s area. So again, the key thing really in the short term for the euro dollar pair especially is going to be the ECB tomorrow, and then the non-farm payrolls and the employment reports out of the US on Friday. So quite a lot of important data coming up, quite a lot of event volatility. So not really looking to do much ahead of those two events, but looking to position on the back end of them. And if we get a pop up into that area and price action signaling that we're stalling here, then I'll likely use that volatility to position for what I expect is going to be a clear ABCD move down into this 108.20 support level. So that's the play that I'm looking at with the euro. Again, it's just the inverse of the situation we saw on the dollar index. We've had that large decline. Now expecting that price is probably a little extended here, and we could see a pop higher before ultimately the downside resumes and we trade lower. Okay, so looking at cable then, and the story with sterling at the moment is that it's been a wild ride these last few weeks. So the uncertainty surrounding the Brexit situation continues to dominate the landscape, with economic data taking a back seat recently. So last week we saw sterling strengthening on news that the Vote Remain campaign had pulled ahead in the polls and won some margin. And then this week we saw sterling back under pressure on news that the latest polls showed that the Vote Leave campaign rather have made some ground and actually closed the gap. So from a technical perspective then, we can see last week the situation that we were looking at. So we were around this level last week, and what I was expecting is that we were going to get a breakout above this high, a breakout above that bearish trendline support. We were going to trade up, retest this big double top at the 147.60s area before retracing slightly, and I was looking to use this area as support. So the move I was anticipating was going to look like this. I was looking for the breakout, the retest, and then I was targeting a move higher. However, you can see we didn't actually get that proper breakout move, and so I wasn't involved in this initial burst. You can see that although we popped above that last key swing high at the 146.60s, and although we broke above that bearish trendline support, the move reversed very sharply, and we actually closed back below that bearish trend line. So this was a typical false breakout, and this is why generally I wait for acceptance above the level before playing a continuation. So I like to wait for confirmation where I'm not totally certain on the levels. As I've said before in sessions, really for these breakout plays, I'm looking for a period of decent momentum into the level before a brief consolidation. But where price is sort of range bound in a very low momentum period, it can be quite tricky to pick these breakouts successfully. And so really to enhance or increase your chance of success with them, it's more prudent to wait for some confirmation. So you can see here that waiting for confirmation actually allowed us to sidestep getting involved in what was ultimately a failed breakout. So you can see we've subsequently broken down on this news that the Brexit polls are showing a narrowing of the gap between the Vote Remain campaign, who remain in the lead, and the Vote Leave campaign, who are coming up close behind. So we've broken sharply lower. On the data front, This is also supportive of the pound under pressure. We've had mortgage approvals and consumer credit coming out much weaker than expected this morning. And although we had a small uptick in manufacturing PMIs, you can see that the prevailing sentiment is bearish at the moment. So cable has just broken back below that 44.70 structural support, and this is quite nice because this is the level that we were roughly trading at when we kicked these sessions off about a month ago. So it's quite clear that this has really been a month of directionless volatility for cable, not much in the way of any clear headway made. So we're currently retracing back below that broken structural support. You can see that we took out the short-term rising trend line. And if we drop down to the 4-hour chart where things are a little bit clearer, you can see that we're currently making some decent headway to the downside. So what I'm anticipating we might actually be seeing form here is a double top. So we've had the failure to break that high. We form the double top. This is our reaction low. So this is going to be the key support location on this move. So if price can get below this level, below the 143.30s level, then we could start to see some serious downside at play. However, do still have to be cognizant of the fact that we have this June 23rd UK referendum coming up regarding the prospect of staying in the Eurozone. So ahead of that, we're not likely to see any clear directional moves unless one side of the campaign, unless one of the campaigns rather starts to make some serious gains in the polls. But for now, whilst it's remaining roughly neck and neck, with margins being quickly erased, we're likely to continue to just chop around in this low momentum period. So it's really going to be after June 23rd then that we get a clear idea of the next big technical move in cable. But going out to the weekly charts, just to get a sense of perspective, you can see that really this current period could still be classed just as a corrective pattern within a broader bearish trend. So obviously we've had the instance of the inverse head and shoulders here, which signals a possible bullish reversal. However, we haven't really capitalized on the move above that neckline, and we're currently holding in this contracting triangle. So a lot of compression in the market, and obviously we can break either way out of these type of patterns, okay? Just because we've come into this pattern in bearish trend doesn't mean it's going to resolve to the downside. But in line with my view that the US dollar is likely to appreciate over the coming months, then I would be expecting that we do get a break to the downside, and a break below that 143.20s level. So a break below the reaction low of this double top is likely to signal some downside momentum for me. Obviously, we have to be careful of rising trendline support coming in here. And if we bring in our Fibonacci retracement, you can see that we also have some key Fibonacci levels coming up, with the 50% retracement level coming in at that rising trendline support. So this is going to be an area to really watch price. I'm anticipating that what we could see happen is a break into this level, a test and a bounce initially, and then a failure here. And obviously this would be quite a nice signal to get short, because we've got this strong momentum coming into the move. And if we hold here, see a shallow bounce and then stall and fail at this point and turn lower, we can look to set shorts on a break of this 42.80 level, targeting a move down into this 140.50s mark. So targeting a move back down into the shoulder area of that big inverse head and shoulders pattern. Okay, so moving on to the dollar yen then. The dollar yen is a really interesting chart at the moment, because we finally made it up to that 111 area resistance. So this is a resistance area that we've been noting over the last couple of sessions. We initially started these sessions when price was trapped in this area here. So we just broken above the last swing low in this bearish trend structure. We were holding with this series of contained price action just below the 23.6% retracement from the January highs, and we were inside this bearish trendline resistance. So we were looking for a breakout above that bearish trendline resistance and move up into a retest of these big broken lows and 38.2% retracement from the January highs. So you can see that we got that move up. We stalled at the initial lows of this resistance area. So this signals that this is quite a strong resistance band, okay? We weren't able to make it as high as the 38.2% retracement or this previous swing high. And you can see we got these two bearish pin bar candles. So this was a really great short signal for any of you who have been in the recent sessions or seen the recordings. You knew what we were looking for. We were looking for a trade up into this area, and this was the key price pivot. So a break above was going to signal the breakout, and reversal price action was going to signal the move lower. So you can see that we're currently starting to really stride to the downside now. Okay, the Japanese yen gaining some support over the European morning today, with news that the Japanese sales tax increase is going to be delayed, so as not to risk further damage to the Japanese economy. So Japanese yen is currently strengthening for now. You can see that dollar yen is testing the area which I was planning to note as initial support, or which still is initial support rather. So we're currently testing this 109.30s area, where we've got the retest of that broken 23.6% retracement. And we've also got these previous structural highs and structural lows. So this is key short-term support. However, I'm anticipating that if we do break below that area, you can see that we've broken below the short-term rising trend line. So if we do get below here, then the next level I'll be looking at, and this is really going to be the key support for me, is going to be this 107.90s area. So if we think about what we were saying with the bullish engulfing candle on the monthly chart on the dollar index, a lot of times these strong monthly closes do see a retrace. So although they're indicative of further upside to come, you can often get a shallow retrace just to kick off the move. So if we do get a move down into this support level, and depending on the depth of the move, we might also test this broken bearish trendline resistance, then I'll be looking for price action here to get me in on a potential long. And these are really great setups that I like to look out for, where we get the where we can anticipate the formation of a head and shoulders, or an inverse head and shoulders rather, then looking to get in at the right shoulder can be a really great risk reward trade. And oftentimes, even if we don't break the neckline, you've got a really good level to play for. So if we're long from anywhere around 107.90s up to 111, it's 400 pips. So instead of going by the traditional method of using inverse head and shoulders, where we'd look to get long on the breakout above this level, if we get a good signal to get long here, then we'll already be nicely in profit by the time we get up to that neckline. Obviously, this level is still a key price pivot for the dollar yen, and so above that level does signal that we're going to get further upside. So we'll be keeping an eye on price and seeing where we get to after these employment reports, with an idea to where we're going to be heading next. Okay, the dollar CAD. So the dollar CAD, the story with the dollar CAD is that we got that breakout. Okay, for those of you who saw the recent sessions, you'll know that we were looking for a breakout above this 130 resistance, which again, this was another move which we actually highlighted an inverse head and shoulders pattern. So we highlighted this area as being support, as the potential right shoulder of an inverse head and shoulders pattern, looking for a breakout above that 130 resistance area, which actually forms a neckline. And you can see that move played out pretty much perfectly. So we traded back down, retested the area which confirmed the right shoulder. We got that bullish pin bar, we broke out above the neckline, and we've subsequently traded up to test what we noted as the initial target on the move. So the initial target on the move was a move up into this previous swing high at around the 130 area. And if I just zoom out, you can see then that the two further targets on the move are a move up into the 32.75 area, and then above and beyond that, the 50% retracement from year-to-date highs at 35.60s, and those big previous broken lows at around the mid 36 level. So those levels are still targets for this move. Okay, you can see that we stalled and reversed from the test of the initial target, and you'll remember that we noted that if price traded back down to retest this broken 130 level, that it was likely to provide decent support. We were likely to see some decent demand kick in there. Okay, and this is often the case when we get these breakout levels. Okay, a lot of orders go unfilled, and a lot of new traders coming to the charts, a lot of traders seeing the charts late rather, have orders to buy there. So oftentimes when we get a breakout of a clear level like that, price likes to retest it before continuing higher. So for now, you can see that we're currently just stalled below resistance at the 130, 130s area and support at the 130 area. So I'm still anticipating that we're going to get a break higher in line with this inverse head and shoulders pattern. And if we do move up, then the levels that I'm monitoring are, of course, this next big swing high with the 38.2% retracement just above, so the 132.80 to 133 zone, and then beyond there, the 135.60, which is the 50% retracement from year-to-date highs up to mid 136s at these big previous lows. So the reason why we got that sharp pullback last week was the Bank of Canada came out a little less dovish than markets were expecting, actually. So markets were taken by surprise there. And then alongside that, we've also had continued upside in oil. So the Canadian dollar remains supported at the moment. And so there is definitely still scope that we could get a move lower with the USD CAD, in line with what we're saying about a possible retracement lower in the dollar index. So we've noted our upside levels that we'll be looking to play for on a continuation higher. If we fall back from current levels, I won't be looking to short this market, but I will be looking for areas that could provide decent support. And so the standout area is really a move back down into this 127.65 area, which was, of course, the shoulder area of the inverse head and shoulders. Now, dropping down just briefly onto the H4 charts, you can see we've got this rising trend line support, okay? And so in terms of initial support, what we could actually see for shorter time frame traders is that this area provides a decent opportunity for getting long, okay? We've clearly got this nice structural area, these broken highs, and we've also got rising trend line support. So if we get a price action signal there that the market is stalling, then that could be a good area to test for a potential move higher. But for now, again, the key is going to be seeing where we get to on the back of these employment reports, okay? I don't like to position ahead of these key volatility events, as the market is often erratic, often priceless and range bound beforehand, and then the moves are generally very erratic. So it really does pay to wait for price action to resolve in the aftermath of those big employment reports to see where we get to and where the opportunities lie. But for now, those are the key levels I'm looking at in the dollar CAD. While we remain above 130, anticipating that we make our way higher to this level initially and then up here. And if we break back down below that 130 level, I'll be looking for this area to provide support. Okay, moving on to the dollar Swiss then. So the dollar Swiss really is another chart which has lost a lot of momentum recently. So we got that big breakout 2 weeks ago now, and this was actually a trade that we gave on the website as trade of the week. So for those of you who don't know, we've been running trade alerts on the website now for 8 months. We're currently up 3,000 pips. We've had 7 winning months out of 8. So if you're interested in those trade alerts, there's actually a discount code, LFX Street 16, which you can use to get 10% off those trade alerts. So this was a trade alert that we gave 2 weeks ago, long from 98.10. We've been as high as 130 pips. We've currently pulled back a bit now to 80 pips. I'm still holding this, anticipating that we're going to move higher to the target level, which is the closing high of these swing highs here at around the 100 mark. So we've currently reversed a little bit, and we're holding in what might turn out to be a broadening top pattern. So although I'm still anticipating that the market has moved through a period of expansion, has entered a period of consolidation, and I'm looking for another period of expansion, I am also aware of the fact that the technicals at the moment are presenting a possible broadening top pattern. So if we discount this rising trend line for now, you can see that these diverging trend lines show us a broadening top. So this is a typical reversal pattern that we see at highs. So I am cognizant of the presence of that. And generally, what I would do in a situation like this is close out the long position if we break below this supporting trend line. However, in line with what we've been talking about so far with the dollar index, with this big bullish engulfing candle on the monthly and the likelihood of some small retracement before we continue higher, I'm actually going to hold this, okay? Everything is quite supportive of further USD upside at the moment. And so I'm going to hold this into the employment reports. My stop is at break even, and I'll be looking to see if we can get a strong print to encourage some further upside. So in the very, very short term, you can see that we're currently testing that initial rising trend line. So we could get the formation of a bullish channel out of this move if this trend line holds. If this trend line holds, then the next key support is going to be this supporting trend line of the broadening top. So this is a market that is still heavily in wait and see mode. as am I. And yeah, we'll keep an eye on this and see where we get to during those employment reports, and hopefully we don't get shaken out a break even ahead of those. Now, if we do run back down into this level and get a signal, a price action signal the market is stored, and then I would look to get long again here, okay? Like we were just talking about, these really clear breakout levels, the market does like to trade back into them and retest them, and that can often be the point at which the proper move occurs. So if price does pop back down here on the employment reports and we get some bullish price action, then I will certainly not hesitate to reposition in this pair. Okay, the Aussie dollar then, and again, kicking off with the monthly candle. So you can see we had a really strong bearish close on the monthly charts, and this is a typical 3-bar reversal pattern that we would expect to see at the exhaustion point of a correction, or just at a general bearish reversal point. So you can see we had this initial strong bullish move. We then had this candle which represents a indecision in the market, so we got this spinning top like candle, and we then got the strong bearish move here. So this typical 3-bar reversal which signals a shift in sentiment, and obviously that lines up with the fundamentals. Recently we had the RBA cutting interest rates for the first time this year, lowering their inflation forecasts and targets, and leaving plenty of further room to ease. However, the move has currently stalled out this week, and we're actually seeing a small bounce because of a slew of positive economic data that we've seen out of Australia. So kicking off the week then, we had better than expected construction and private credit data. And then overnight, we had a much better than expected GDP print for the first quarter, both quarter on quarter and year on year. We also have further support from a data beat out of China with a positive manufacturing print. So that's the reason for this current bounce in the Aussie. Now, looking at the technicals then, you can see that this current bounce has taken us into a very interesting area and a very key short-term price pivot. So this retest of the 7250s area is key, because you can see that it was actually the area of the last resistance made before we got that big breakout in the Aussie back into mid to late February. So this was very key resistance for the market before we broke out. We traded back down. You can see we found support initially. We've now traded back below it, and so we're retesting this area. So forgive me if this chart looks a little bit messy, but we've still got the same lines on from last week to keep some continuity with what we're looking at. You can see we traded down into the 61.8% retracement from the year-to-date lows. We stalled out at that level. We were testing just below it before reversing higher on these data beats this week. So we're currently retesting this key structural level. Now, at the moment, we're really struggling here to hold above it. So if we do get a daily close below this level, then we could be in for some further downside. However, if we do get above that level, then the next area which we can see will be a clear target for the move is a move back up into this big previous resistance at 73.30s to 73.80s. So this is a really key level for the Aussie. It capped those two big rallies last year. We then broke out above the level, and you can see we didn't actually find much support on the move down. So sentiment shifted very strongly in the Aussie on the back of those RBA, on the back of the RBA rate cut this year. So as we move back down below that level, it's likely now that if we retest that area, we're going to find strong selling interest and a resumption of the bearish move. So again, in line with what we're talking about with the dollar index, but maybe retracing a little bit lower. If we get a pop up into this level on the Aussie dollar, then this could be a good area to look for shorts, ultimately anticipating that we're going to get a move back down into the 78.6% retracement level and around this 70.40s mark before ultimately making our way down here. Again, although pretty much reliant on what happens with US data now over the coming month and what happens with that June FOMC. So we're really approaching a very key period for the US dollar and for the majors markets in general. So wrapping up finally then with the New Zealand dollar. So the New Zealand dollar, this is a very interesting chart at the moment. You'll note that last week we were talking about the market really struggling at this level and being in a period of strong congestion. So I was talking about potentially playing a breakdown from this level, targeting a move into the ultimate target, which is down here at 65.40s to 65.50s. However, you can see that what actually happened was we got the fake out and we got run and reversed. So price broke just below that level before reversing and trading sharply higher. And this is actually a situation that I'd warned about in the Kiwi specifically, I think 2 sessions before, when we were trading at this point here. So I was looking again for a breakdown, but again, I noted that because the market is so congested and because we're in such a low momentum period, that what we actually ran the risk of was price breaking just below that level before reversing and forming a double bottom. And you can see that's pretty much what's happened again. We got the breakdown, but market reversed and traded higher. And this is very typical of this type of period. It's why I stay away from trading charts when they look like this. So you can see just how congested this area is on the Kiwi dollar. It's very difficult to pick breakouts in markets which are so congested like this. As I was saying earlier in the session, the way that I really like to play breakouts is looking to identify clear momentum in the market, such as we have here, so a clear directional move, and then a brief period of consolidation before a continuation lower. But where we get these long drawn out periods of range bound action, what we often find, especially during these low momentum periods, is that the market likes to test above the highs and reverse, test above the lows and reverse, and it's simply a question of rotation. There's no real force in the market, there's no momentum. And so until we start to make some room in this chart and really start to drive and get some sustained directional moves, there really isn't anything doing for me. So I'm still anticipating that we're going to get a break lower at some point in line with bullish dollar view. However, this chart is probably the strongest indication of what we're talking about in terms of the US dollar pulling back and some of these currencies actually gaining against the US dollar in the short term. So you can see the New Zealand dollar has reversed strongly here. We've broken above that short-term bearish trendline resistance, and we're now coming up to test the key structural resistance. So this 68.30 level to 68.90. So this is the previous resistance level which capped the rallies last year. So this is going to be a very key test for the Kiwi dollar. So as we trade up into these levels, I'll be monitoring the market, and really what I'd like to see is a trade up into the upper level of this resistance zone before we get a reversal, and from there I'd like to see the market make some momentum, display some momentum rather, and make a clear directional move lower, and then I look to position short on the break of this low. But what I'm not going to look to do is get involved in this whilst we just remain in this range. So I'd like to see some real room made and then get a strong move down into that level before looking to position. So if we do break above this level, this isn't a pair that I'm going to be looking to trade to the long side either. Again, I'm still anticipating that the US dollar is going to advance. So I'll be keeping an eye on the employment reports on Friday and seeing where we get to, and then looking to position on the back of those. So some clearer opportunities in some of the other pairs, not so clear here in the Kiwi dollar. And the name of the game really is just sitting tight, waiting for these employment reports on Friday, not getting sucked into any of the low momentum moves ahead of that, and then looking to take advantage of the much clearer levels as we come out of this period. Okay, so I hope that's been useful, guys, and hope you're able to look back over the session when it's recorded and identify these key levels again and get them marked up on your charts and see how we fare between now and the next session. So thanks a lot for tuning in today, and I look forward to catching up with you all next week. Good luck and good trading.